When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also talk about how to prepare for falling interest rates. We'll answer listener questions, and then if we have time today, target date funds explained. My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Jeff, how you doing today?
I'm doing fine. How are you doing? Always good to be with you.
I'm doing well. Jeff, always glad to be with you, and of course, always glad to be here with the fine people of the greater Tucson and Mesa area. Jeff, we're going to be talking about current events, of course, but we cannot do a radio show, I think, here without mentioning Charlie Kirk. When you first heard of the assassination of Charlie Kirk, Jeff, what were you feeling?
I don't know. I was confused, mad, angry, sad for the state of the country that people would take out a guy that was doing nothing but trying to do good, had his feet planted in truth and doing the right thing and God-fearing man, all those things that our country was founded on. Turning Point was an amazing organization founded right here in Arizona. Charlie Kirk's a neighbor and a friend to many of our listeners, probably. Many people that I've come in contact, I didn't realize how close they were to him. One of my friend's brothers works for him, and just a lot of different things went through my mind, mostly just confusion. I was like, why? Why in the world would this happen? I know some people say, well, he's a God-fearing man. Why didn't God stop it? Well, I don't know God's designs. I think he does. And I think God lets bad things happen so we remember that he's God. And God allows bad things to happen because the world's an evil place and we have agency. We have the right to choose right from wrong. We have the right to, how can God look like God and look like a good thing if there is an evil that in opposition against it? And that opposition shows up in all kinds of different ways. And so I guess my own spiritual perspective, beliefs and value system, which mirrors Charlie's in many ways very aligned, kind of helped me see the perspective on all of it and find peace in spite of the chaotic nature of such a thing. I'm glad they've got the person that did it. They seem to have evidence that he was involved. I don't know how much I trust government, law enforcement, and all the people that are supposed to be telling us what's really happening to be telling us what's really happened. The fact is he's gone. The fact is a beacon of light that changed the lives of many people is gone. But I was really amazed how his wife put it, Erica put it a couple of days later, that you don't understand, you evil people that think you silenced something that was opposing your own belief system somehow shut it up or killed it or got rid of it. You don't understand what you just unleashed. And it's amazing to see that, I just read a thing on Instagram. I try not to be on it too much because that's a rabbit hole you can get messed up in. But I was looking at it and seeing some of the Charlie Kirk videos and just remember some of the things that I'd heard him say, kind of reflecting on the message, and which is a good message and a common sense message. He didn't fight. They say he was divisive. Well, he was divisive because he was really on the side of good and right and truth. And there's the evil side of the people that are messed up that don't understand that. Makes it kind of more of a polarized conversation sometimes, but he never did it with intent to belittle or to hurt people's feelings, although I think people's feelings got hurt just because they wanted to dig in and believe in their own way of life or belief system or whatever. But I think he was a great debater. I think he changed a lot of people's minds or way of thinking and made young people believe that they could actually think for themselves instead of being indoctrinated by colleges and other people. Basically manufacture this generation of lemmings that would just vote and do what they want to do based on what they felt the world was, and the kids didn't have a choice to believe what it was in their own mind. So he opened that up, and I was really amazed that on Instagram, apparently he's got something like 17 million followers. He had like 1.7 before he died. Now he's got 17 million. This speech by Erica, his wife, that mentioned that this is going to be bigger than ever, and she's, her voice is going to be like a battle cry around the world. Amazed at seeing the people, like even in Korea, chanting, we are Charlie Kirk, doing vigils for Charlie Kirk. Who even knew who he was in Korea? What about Europe? There's all these different places that are recognizing him. Now he has 10 times as many followers, 10 times as many people are getting his message and seeing thousands and thousands of clips of his wisdom being shared to young, impressionable people, telling them that they can think for themselves and have a high-level value system based in truth and faith and God and Christ and those things that will help them find happiness and direction in life and give them perspective on what a crazy world this is. And I think he definitely was focused. He was well-grounded. He was rooted in good things. And I think other people can use that example. I was amazed too is the chapters, the home base of Turning Point is right here in Phoenix. And I was amazed at how many requests for new chapters. I think it was 1,800s when I looked at it like a week ago. And there was only 1,100 before his death. So, I mean, look at the exponential growth and look at the scaling of this movement that happened because it was brought to light, because this tragedy happened. There can always be, my mom always said, how do we make lemonade out of lemon? How do we make good come out of a tragedy? And he's going to be remembered for a long time. There's no doubt it was a political assassination from the standpoint that politics made the divide between what the people that chose to believe and think and, I guess, live their life according to how Charlie Kirk lived. His value system was very more in line with the right side of the aisle than the left, and left didn't like the idea that we could think for ourselves and believe in God. And, they wanted separation of church and state and never to have Christmas, God, or anything of that nature mentioned. And so they were really the opposition. So you can call it a political assassination, but I think more than anything, it was an ideological assassination of people that can't think on their own, can't allow anybody to have a differing opinion of them or they're wrong. I mean, America was founded on free speech. America was founded on the idea of freedom through and through. He was basically the epitome of free speech, and he was letting everybody talk and give their speech. He was very gracious in letting them say what they wanted to say. He would dispute it based on his value system, but there was dialogue, and that's the way things should be, not censorship or, you said something that's offensive to the government or to somebody that's in power and you got to be taken out. But that's what eventually happened. So he does make it political, although it's really just based on good and evil and a value system that should be prevalent in America, not shut down in America. But there's such a big faction of, I would call it evil, that is growing and growing to do the work of the adversary, not the work of Christ and God, and to cause chaos, division, hatred, and even death and murder amongst us so that we can't live the fullness of the blessed life that God intended for us. And I guess that's really why we're here. That's the earthly experience, right? To get through the obstacles that are in front of us. Nobody ever said it was easy. Trying to live like Jesus taught is hard. The saying is nobody ever said it was easy. They just said it would be worth it. And if you do have faith and believe that there's more to come after this life, then you're faith focused, then those messages of Charlie Kirk resonate with you. And they resonated with me. I do believe there's more than just this life, and the trials and the tragedies that we deal with are for our own experience, our own earthly experience, but there's more to come. And however we're allowed to be here in this earthly journey, God only knows. But he will allow us to be here as long as we need to learn the things that we were sent here to learn. And for some of us, I may live a really long time because I need to learn a lot of stuff.
Right.
And, Charlie Kirk apparently learned and did enough to where his message is going to resonate and cause a difference and carry forward for generations. God used him as an instrument in his hands to change lives. Interestingly, it's probably stronger than ever, and I don't think he could have 10x'd it as quickly as it happened. As unfortunate as the circumstances are, the light and the good that you can see coming from it can still outweigh the evil and the darkness in his death. So we'll look at it that way. We'll look at the positive things that could come out of it. I hate to think the world is such an evil, pessimistic place that I live in fear and that I live in a dark place or an unhappy place or get so frustrated that I can't have a good day. The fact is we have to have a good day. We have to look at those things that are good amongst all the dark and bad and weird and bad things that happen to us. So I hope we can do that, move forward. There's always positive outlooks and live each day like it's your last. I mean, who knows? Charlie Kirk didn't know that was going to be his last, I'm sure. Nobody did. We only have so much time on earth. We don't know what it is. So let's make the best of it. I think that's a positive message we can take from it as well.
Well, I think evil is real and Satan walks among us, sometimes in plain sight. We're talking with Jeff Ogun of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Jeff, Utah Governor Spencer Cox, he's been very candid about this tragedy. He said we need every single person in this country to think about where we are and where we want to be, to ask ourselves, is this it? Is this what 250 years has wrought on us? I pray that that is not the case. At some point, we have to find an off-ramp, or it's going to get much, much worse. When you hear that, what does finding an off-ramp look like to you, Jeff? Is it possible for conservatives and liberals to just step back from the edge a little bit right now?
Well, I think so. I don't know that getting to the middle, I don't think the right side of the aisle needs to dumb themselves down and go down the same direction. I think what we have to do is meet in the middle from the standpoint of agreeing to disagree, agree to allow other people the freedom to think their own way, even if we think it's absurd, even if we think it's ridiculous and insane. But the fact is, we have a right to be ridiculous and insane as long as we're not hurting other people. And the fact is some of this insanity has come around to start hurting other people, and it's not a good thing. So I don't know, can we agree to disagree? Can we try to at least agree that human life, that there's a certain sanctity of human life that is worth preserving and not laughing about or cheering or celebrating? I mean, it just blows my mind that that even happened to people that are in charge of our kids, people that work at schools and colleges and in corporations, even, where they're making decisions and communicating to our children things that are so far off the scale of, I guess, my reality or my sense of decency, that it blows my mind that they would be in those positions if they feel that way. I mean, can we at least get back to a place where we can at least agree that somebody's beliefs or somebody's speech doesn't get them killed or isn't worth dying for? Then again, we've had martyrs for years and years. There's a lot of people that have died for what they believe in and been shot for stupid reasons. I mean, assassination isn't a new thing. There's been several, Lincoln, Kennedy, and many others that have been killed for stupid things, and maybe in some cases political power and other reasons. But I think in all cases, if we memorialize the good from those people and the messages that they had, then that assassination, it doesn't squelch anything. It doesn't stop anything from happening. The good can still come from those people that try to do good things, as we carry that legacy on by doing the same thing and by, I guess, embracing the good from those things.
Jeff, as we wrap up this conversation, I think many young conservatives are really shaken by this, and they looked up to Charlie Kirk. We know that. They're angry, they're afraid, and they wonder what comes next. So I guess you have to ask yourself the question, what kind of legacy do you think Charlie Kirk leaves behind? And it's beyond politics, it's beyond the controversy. And you've got to ask yourself, how can we as people honor that legacy? Talking with Jeff Olguin of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about Charlie Kirk. We're going to be talking about current events here in just a moment. Our telephone number, 520-780-9059. If you would like to sit down and talk with Jeff, if you want to talk to him about Charlie, that's fine. If you want to talk to him about your retirement portfolio, certainly we would love to do that and help you out with that. It's called the Retirement Roadmap, no cost, no obligation, 520-780-9059. You can make that call right now. You can also find out more about us online at premret.com, PREMRET.com. Jeff, let's talk about current events here. Inflation 2.9% year over year in August. Core inflation running even higher at just over 3%. What does that really mean for the average American household, and especially for retirees who are trying to stretch their dollars?
Well, 3% inflation is still 3% inflation. And, as long as you're making 4 or 5% on your CDs, your money's keeping up, but it's not getting ahead. It's just keeping up with that inflation. The economy, we had a mandate that after the big inflation year, 2022, 2023 wasn't too good. 24 seemed to get it back into control in the 3 range. But now we're accepting 3 as the okay number, where 2 was the mandate. Never really got to 2. And the fact is, just because inflation a year ago was growing at 3% and today it's growing at 2.9, they're talking like inflation is down. Well, that's not true. 3% from last year and 2.9 from this year means we're paying 6% more from a year to 2 years ago for everything. And if you're making $100,000 a year and spending every penny, now you need to make $106,000 a year. Have you got that kind of a raise? Maybe, maybe not. But the thing is, insurance, food, and other things as part of that inflation factor are growing at a higher level, a big number compared to the 3%. That is the total inflation, overall inflation, because there are certain things like technological things, because advances, certain things go down in price, and other things that are more staples and more of the consumables and those things that you have to have are the ones that are getting hit harder by the inflation factor. So I think we have to realize that inflation, just because they say inflation is going down, it isn't. It's just going up slower. And the fact is that we've had, we're up about 30% since Biden started this big old inflation kick. And it wasn't just Biden. It started with Obama, and even Trump's first round with COVID created all these opportunities for stimulus to just keep pumping money into the market and fake the market out. When there's all that extra money going in that has nothing to do but go to rich people and banks and institutions that buy stock, and they drive the stock market up. And then people that might have stock, some of the middle class people that have stock or upper middle class people people that have stock. Not poor people. They don't have any of that stuff. So they don't get any of the benefit from all this money printing. Sure, they send $1,200 to each person to get them through COVID. What a joke. If you were sitting in your basement and had a Robinhood account and put it in NVIDIA back then, you might have a few $1,000, but chances are you spent it because that's what it was meant for. And if you spent that money, it created more inflation. So we have this big inflation kick. I mean, we're paying 30% or more than we did just a few years ago for everything. And it does impact not just the basic consumer and the young parent who's trying to raise a kid or the young couple that's trying to create a family and have more and more expenses incurred as the years go by, when inflation on top of that is keeping ahead of most people's ability to get raises from their jobs and other things. So it's a big deal. I think with retirement, retirees have to worry about inflation as well. The nice thing about the higher interest rates is that at least the interest rates are keeping up. You don't have to take risk to do that. However, if interest rates start going down, the bond market starts increasing in price, which makes the interest rates go down. Or if Powell actually continues to have this, we're going to lower interest rates, which makes price of bonds go up. If you have a bond portfolio, you can start making money on bonds again. The interest rate's going to go down. The other thing that it does is when you print money, or in other words, when you buy bonds, basically you're buying bonds and you're raising the price of the bonds. In order to lower interest rates, you have to basically pump money, which is really how we print money, is money has to go into those people that held bonds, banks or other institutions. Now there's more money flowing around. There's more cash. So where does that cash go? Well, it either goes and pumps stocks up or it goes to buy more goods. And guess what? It's not the average Joe that gets that money. It's institutions and rich people. I don't dog on rich people. Most people got rich because they took some risk and they deserve to be rich. But the fact is, it doesn't help the middle class. It doesn't help the average person. And it's kind of an institution that was created to basically protect the rich people, the Rothschilds, Vanderbilts, and big money names from back in the early years before the Great Depression, when all the rich people kept getting richer and richer and they suckered everybody else to buy stocks. And then the Great Depression happened, but somehow the rich people stayed rich people. That's because they own the banking system and the Fed is really their system. It's not a government agency. If you thought it was, just because it's named Fed, think again, it's not. It's basically a partnership between a private entity where the president gets to appoint certain people on the board, but they work at the direction of the banking partners and kind of do their own thing. Now they can get pressured by the political leaders, and the White House, wants them to lower interest rates, and maybe they'll succumb to that because they know that the next Fed chair or the presidents of each of the different Fed districts are going to be appointed by political leaders. They try to toe the line a little bit, but make no mistake, they're to prop the banks up and they're to make them rich, not us. So lowering interest rates is going to just create more inflation, which means your money is not going to make as much interest, but you're still going to have to pay probably more than 3% for goods and services a year from now if they keep lowering interest rates. So we have to keep that in mind. And it's really kind of a catch-22. The other thing, I think we're going to see some market weakness going forward here, because I think the smart money realizes that when the Fed lowers interest rates, it really is kind of a capitulation. It kind of means, hey, there really is a recession. We really have to lower interest rates and create a little bit of economic stimulus so people can spend more money. Unfortunately, the inflation's already high. It's just going to cause more inflation. Interesting, on the news, I heard a clip that according to the Fed, there's plenty of room to drop interest rates, even though the economy is clipping along at a great pace. Well, the economy isn't clipping along at a great pace. We've had about 1.5 million job numbers that were indicated as new jobs over the last 2 years that were actually told to us were fake. Under Biden, a year ago, like in April, I think it was, when they came out and said, oh, sorry, we thought we had 1.5 million jobs, but it's really only 700,000. There's 850,000 jobs really weren't made. Sorry. Oops. And so that person in charge of, I think it's Bureau of Labor Statistics, stayed in control. The election happened in November. By this April, when they go back and audit the numbers for the prior year, they find out that there's 900,000 jobs that were miscalculated. So Trump fires the director of the Bureau of Labor Statistics and gets a new one. So now we are supposed to have good information. I'm not sure we have good information or not. They touted we lost 300,000 full-time jobs and got 900 part-time jobs or something like that. I can't remember the numbers, but it was like ridiculous. So now we're finding out the truth is we're giving up full-time jobs and getting more part-time jobs, because I think some people have to get extra jobs because their jobs aren't paying as much. So they have to work 2 or 3 part-time jobs in order to make ends meet, because the economy isn't as good as everybody says it is. So when the news says, oh, the economy's going along at a great clip, really? Well, we're just getting some bad information. The market is going along at a great clip because banks continue to buy their own stock. Shoot, Elon Musk a week or so ago, bought $1 billion of his own stock back. Why did he do that? Well, I think it's because he heard Larry Ellison of Oracle jumped ahead of him as the highest net worth person in the world. And I think he got a little egotistical and butthurt about it. decided to buy $1 billion of his own stock back, which drove the stock up, 30% or something stupid. So now all of a sudden his net worth can be bigger than Ellison's again. I think it's just an ego thing. But when you buy your own stock back, it creates an overly inflated price. When you're buying billions of dollars of stock, it can drive the stock price up. And that's what some of the market makers are doing, like the big banks, is they're buying their own stock, they're buying other stocks, they're driving the prices up. They're giving us this false sense of, the market is strong because the stock market, because people are willing to pay 2 or 3 times what a stock should be selling for, then somehow the economy's good. But ask all those people, the 1.5 million people that supposedly have new jobs that really don't have new jobs. I have a lot of pre-retirees that thought they could work till they're 65 and they're getting laid off when they're 61 or 62, barely old enough to get Social Security. But if they do, they take a big hit and they don't have that extra 3 years of 6-figure or better income to support them in retirement. They have to rethink their plans, rethink their lifestyle, rethink downsizing their house and other things. And that's reality. And I'm seeing that firsthand. It's not the robust economy you're hearing on the news. And I'm not being a doom and gloom guy. I'm just saying the economy's not that good. And if it was, the Fed would not be lowering interest rates. And as soon as the Fed decides to lower interest rates, typically the knowledge that it really is a recession happens and smart money starts selling stock. And that's why I believe there's going to be some weakness this fall, probably through the end of the year. And we'll see how that goes and what that means. But, based on the Fed lowering interest rates, it may be a very temporary pop in the market here and there because of, the hoopla about lowering interest rates. But most of that's been priced into the market, I think. So I think we've had an overly hot market, what we call it, excessive exuberance in the market pricing and what people are willing to pay for stock. I don't know how long that can last. And I've said this is going on 3 years now. I've had this radio show a lot longer than that. I still want to be cautious. Having said that, we have a growth portfolio that's beating the market. We do really good picking the stocks and ETFs and different things based on what we see happening. But we're also very cautious. And we also warn people that if you want to go down these waters and try to swing for the fences and ride this horse with the rest of the crazy risk takers that are pumping it up over historic values, only risk the money you can afford to lose and jump on board, but be careful. It could hit us the other way too. So again, it's kind of walking a fine line between how much risk do you want to take? How much can we believe in this market that's really pumped up by fake numbers that we're finding out as far as economic statistics and things like that? Companies that are claiming, for example, companies are claiming part of their earnings as their stock trading. If they buy and sell their own stock and make money on it, they don't have to sell a widget, or they don't have to sell what they're selling or provide the services that used to get paid for. They can lump that all into growth. And we've heard that with the last couple of quarters with bank financials. When they come in with earnings, they say, oh yeah, we made a ton of money on profits on trading. Well, that's because they're doing a lot of trading in the market and they're trading, by and large, their own stock. They're also the inventory holders of all the stock market. And they could decide how much they make on each share of stock when it buys and sells. And they've been manipulating that as well. So there's a lot of things that I've seen over the last 30 years that taught me about the market. But man, I'm learning so many new things the last couple of years of how much manipulation and how much trickery and just flat out in your face manipulation that they can do. And it is a little troublesome, to be honest with you. So, when that comes all to inflation, what they're going to do to curb inflation is probably going to manipulate the market some more. Just be careful if you're playing in it. We'll see what happens. It all remains to be seen, but the market's a crazy place right now.
Jeff, I want to take just a moment to remind our listeners that if you're looking to preserve your wealth so you can have a better retirement, if you want to create an income stream that you can count on, if you want to reduce taxes, our Premier Retirement Roadmap just may be the thing you need. To get yours, no cost, no obligation, call 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week and set up a time for you to meet with Jeff on a one-on-one basis. Again, it's just a casual conversation. 520-780-9059 or online at premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll be answering listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Ogen and Jeff Shea.
Thank you so much for listening to Premier Retirement with Jeff Ogen, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're on for you 4 times a week here on KNST. You can hear us on Saturdays at 7 a.m., also at 9 a.m. and 1 p.m. Also, we're on Sundays at 11 a.m. And if those are not convenient for you, remember we're also a podcast. Go to wherever you get your podcast. Search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number 520-780-9059 if you'd like to take advantage of the opportunity to get your no-cost, no-obligation complimentary retirement roadmap to see where you stand. It's 520-780-9059 and our website is premret.com. Jeff, time for listener questions this week. Ken starts it off in Tucson. Ken says, I'm 63, my wife is 61. We have about $1.2 million in retirement savings now, mostly in the market, 401ks, and about $200,000 in cash. We want to retire in 3 years. What do you believe is the most important factor to figure for when planning for retirement?
Well, I think the biggest thing is how are you going to guarantee the income you need to pay all your bills? And maybe you have some pensions, maybe you have some Social Security that's going to pay those bills. You're retiring in a few years. You've got about $1.5 million. You probably have maybe a little bit more than that if you don't lose any money. I think the biggest thing you can do right now is make sure you take off the table what you need for income before the market crashes, or if it is exposed to the market, before something bad happens. So I think you have to count your many blessings in how the market's done if you have, in fact, taken advantage of some of that growth that's happened the last few years, and convert some of that into income producing products. You know, depending on, now you do have some qualified money, and I don't know what your income is right now, but you're potentially in a high tax bracket, getting close to retirement. It may not be a great idea to start depleting that IRA or 401k now, but you might want to consider putting some of your non-IRA money, your after-tax money, into a LIRP, life insurance retirement plan. I like that for income if you like saving taxes. I don't know what your pension situation is, your Social Security situation, or what tax bracket you will be in when you retire, or even how much money you need to live on. That was a few questions that I would ask you if you came in and we did the plan. But if we go through those numbers, and we might find out, let's just say we need $700,000 out of that $1.2 million to be put into an account that will guarantee you forever $60,000 a year or $50,000 a year. Well, if you use the idea of the stock market, who says 4%, there's been a theory of 4% is really the most you should take out if you want to be certain you're not going to run out of money in the next 25 or 30 years, which is probably what most retirements have the potential to last. So we like to plan for at least a few decades, or at least till age 100. Maybe you might live longer, maybe you live a little shorter, but we want to make sure your money lasts as long as you do, no matter if you do exceed your expectancy. So again, do you want to use a 4% rule and take $60,000 out of $1.5 million and have it go up and down and have you sweating bullets every time the market's crashing and feeling pretty good about things when the market's surging? You know, that's a roller coaster ride, and most people don't want to have that extra emotional roller coaster ride in retirement. They want to just sit back and enjoy and have confidence that their bills are getting paid. Well, it may come out that maybe 60%, usually it comes out somewhere in the neighborhood of 60% of what you have saved you can use and put in a more guaranteed principal protected account that guarantees the same income that you could have had based on the rule of thumb with that Wall Street touts. Now, by the way, that Wall Street rule of 4% has been proven wrong by people that actually have degrees and PhDs in retirement income analysis. Anyway, there's actually a degree in retirement income now, a retirement income specialist, a designation you can even get. But there's a guy named Wade Pfau who came up that the number should be around 2%, because if we have another decade like the lost decade of 2000 to 2010, and we have two market crashes during that time, if you have a stock and bond portfolio, those bonds aren't going to help you. And by the way, last time the market crashed in 2022, it didn't really crash, but it had a pretty good correction. We were over 25% down or so on most portfolios, most indexes. Well, the stock market crashed and came back, but the bond market went down and continued to go down. Now the bond market over the last 2 or 3 years is down 10 or 15, and the longer term bonds are down 20 to 25%. So you would have lost money on even the part of the portfolio that you thought was safe money. So if you're spending that money during a down market downturn, you don't have the access to the upside of the market when the market turns and corrects. So I like principal protected products. The other thing I like, and I started mentioning it, like if you want tax-free income, I love LIRPs for that because it's tax-free. By the way, when markets turn down, you actually don't take money out of that account and lock in losses. You actually borrow against the future growth of that account. So it doesn't matter. It just sits there stagnant if the market's tanking, and it grows when the market goes up. So you still have access to the future growth of that account with no market risk, and you can do it on a tax-preferred basis, tax-free in most cases. So that's one way. And if you want to keep some income coming out of your 401k because you know that just a flat income is going to keep you under a certain bracket, then we might want to use some of that IRA or 401k money to go into a principal protected annuity that would generate guaranteed income. But I only use the annuities where you don't give up control of the annuity. If you want to cash it in, you can get your money back. If you die, your spouse gets the money, your kids get the money. You don't give up anything to the insurance company from a standpoint of accumulation value, you basically just insure that account to pay you income as long as you're alive. And if for some reason that income runs dry, you still get paid. And that's something that the stock market or the bond market, anything in the securities world can't do. And it's interesting, they call the securities world, with the root word secure, anything that has risk. So I think securities is kind of like a mind game that they're trying to make us think that somehow stocks and bonds are secure. There's nothing secure about them. They all have risk. So be careful. Now, it can create great wealth. And I believe that to the extent that you don't need to set aside certain amount of money for income, you should be in the market when you feel you can take the risk, or you don't need that money for a period of time. Many of our clients that have, let's say, a third or half to maybe even 2/3 of their money in principal protected accounts that generate income and that they can always count on to live on, and they already know what income that they're going to enjoy during retirement, and they have that confidence, you might have a third, maybe 40 or 50% in the market. You don't want it all in risk. You can still diversify between different sectors of the market. Maybe you only have 20 or 30% of that that's aggressive. Maybe you want to go into gold and silver. The thing is if those markets don't do well, the other money is providing enough income so you can pay your everyday bills. So, I think income in retirement is really the key. My clients, we don't have very much turnover. Hardly anybody leaves. They usually stick around the long haul because their income needs are being met. You don't get worried, scared, and go looking for another advisor who can make you more or lose you less, or the other things that happen with when all your money's at risk. You get too emotional and everybody freaks out and they want to change things. The industry, I think, enjoys I think it's somewhere around 20% turnover. So 1 out of 5 people are getting frustrated with their advisors every year. Well, tell you what, you probably won't get frustrated with your advisor if that advisor has set you up in a plan that has income that is guaranteed till you die, and your spouse as well, to an extent that it's more than enough that your bills are covered. You don't have to sweat the other stuff. You can enjoy your retirement, probably live longer because you have less stress. So you ask what the most important thing is, I think it's the income plan.
Ken, thanks for listening to us in Tucson. And again, we'll send you out Jeff's book, Retirement: The Road Ahead. And again, if you'd like to talk to Jeff, 520-780-9059 is the number. Gary's listening to us in Vail. Gary says, my brother-in-law has been talking to us about a family limited partnership that he set up for his family. What is that, and what are the reasons one would want to do one?
They're few and far between now. I think the reason, back in the day, we used to do them when the estate tax was $1 million. Anything over that got taxed at 40 or 50 or 60%. Now, if you're married, you can get $25, $30 million or so in estate tax exemption. But the bottom line is, if you put everything in a family limited partnership, say, hey, all my assets are owned in this partnership, because it does not have market value, you can't just take it out and sell it for full value. You actually get a discount on the value. So that's kind of an estate tax planning gig. You can also take withdrawals from it on a tax advantage basis. It's typically for high net worth people. Sometimes you have a business. You don't necessarily have to have a business. You just have to have assets, and you can create a family limited partnership. You can make distributions from it. It's really kind of a way to, I guess, reduce the value of your estate so it doesn't look as big when it gets taxed. It's mostly for tax reasons. I don't think it makes your life any easier to run because there's an extra tax return you have to do, and there's a couple of rules and hoops you have to jump through to make it work. But it's mostly for tax savings. I mean, it doesn't change the nature of the asset you own. If you own real estate, you can still own real estate. You can still collect rents and do that. If you own a restaurant or you own a furniture store, you can put that in a limited partnership and have the same similar thing. You can still get the income, and the bottom line can grow and the asset can grow. You can distribute portions of that estate also in order to not have all of it when you die. But again, I think that's less popular now than it was when the estate tax level was lower. It's an asset freezing technique. In other words, it makes it look like your estate isn't really growing because you can actually start shedding portions of the estate at a discount to your heirs, use gifting and things like that to play tax games.
Gary, thanks a lot for listening to us in Vail. Of course, you'll get Jeff's book, Retirement: The Road Ahead. And again, if you'd like to talk to Jeff, 520-780-9059 is the number to use. Next question, Jeff, is Bill hearing us in Sahuarita. Bill says, the question I have deals with Roth conversions. If I convert $100,000 this year in November or December when I see my tax situation, will I be hit with an underpayment penalty if I pay estimated taxes for only the last quarter of the year?
Good question. The fact is the IRS doesn't like when you do the estimated taxes and then you all of a sudden have a big quarter. The way you can get around it, and the way, I hate to say it, but unfortunately it might mean you have to take extra money out of the IRA or take a distribution and have it just be considered 100% withholdings. You can do withholdings up till the last day of the year. And if it's withheld from a qualified account, then you don't have to worry about coming up short on those quarterlies. So if you anticipate taking money out and you want to just pay it out of after-tax funds, then you probably need to at least, even though you might do the conversion in December, you think it's going to be around $100,000. It might not be a bad idea to maybe add $4,000 or $5,000 to your quarterlies to make sure that you have it if you don't want the penalty. My take, however, is totally opposite. I couldn't care less about the penalty because I got to use my money for the whole year. There's opportunities to invest where you can make 6 or 8% on your money in, relatively short period of time, or maybe even more in a year like last year. If you had market returns, now you could have lost money as well. But if you're fairly confident in your ability to protect against losses and make money, we like you just not worrying about the penalty. If you want to do the conversion, rather than pull extra money out, let's say if you have to pull $125,000 out so you can withhold 20%, so you can have $100,000 to convert your Roth IRA. Well, you actually had to pay taxes on $125,000, not $100,000 that went into your Roth, right? Well, is paying an extra $5,000 in taxes on that extra money you pulled out this year more than, let's say, the penalty on $20,000 that might be maybe a couple $1,000s in penalty, where you got to use your money all year long. So it's really up to you. If you've got a really conservative investment portfolio and you're getting money market interest or CD interest and you'd rather not pay more for a penalty, then just up your quarterlies. They don't like it when you do that. That's kind of a red flag, unfortunately. I think it's wrong that they do that. I think it's wrong that they make you pay quarterlies at all. I think you should be able to withhold at the end of the year or pay in at the end of the year based on what you earned, not what you earned last year. Because shoot, I'm a business guy and I make a different amount of money every year. It could be more or less. Most often it's more, but it could be a lot less, just depending on we have a bad year, market crash. Sometimes people get a little skittish and we're not managing more money, we're managing less or whatever, and stuff happens. So what if, do we have to pay, in order to not get a penalty, we have to pay taxes on what we earned last year or more? I mean, that's just, it's ridiculous. I don't like the IRS. I never have. I like tax planning. I think you're at the right track. At least you're doing Roth conversions and you're getting all that money at least out of the taxable column on your future income tax returns. And that's a good thing. But there might be some other more efficient ways. And when we do a plan, we actually set aside the quarterlies, and then we typically will just do a withholding at the end of the year, because there is a benefit to that. And that is you're whittling down the asset base in your IRAs and 401ks, depending on what your tax brackets are going to look like in the future. You may want to just go ahead and take that extra in order to draw down that asset so that you don't have to be forced to take required minimum distributions at such a high level that you're going to be pushed into a new tax bracket later. Sometimes it's better to pay taxes on less money now at a lower tax bracket than try to squeeze every dollar out of the taxes now and end up with a higher tax bracket on more money later. So those are all reasons that you need a plan. We need to see it out on our spreadsheet template, our income plan spreadsheet template, and it'll kind of help you make the right decision once you see the numbers. But those are the things you need to consider.
Bill, good question. Thanks for listening to us in Sahuarita. Of course, you'll get Jeff's book, Retirement, The Road Ahead. And again, if you'd like to talk to Jeff, 520-780-9059 is our number. You can request your retirement roadmap at no cost and no obligation. 520-780-9059, or also online at premret.com, premret.com. Jeff, in portfolio management and planning for retirement, I've heard of target date funds, so I thought I would take the opportunity in this particular part of our program to educate and inform people about target date funds. First off, the big question is, what exactly are they?
Target date funds are supposedly something that kind of automatically, for people that are just really don't want to mess with their stock and bond mix. The stock market, the Wall Street considers stocks aggressive and bonds not aggressive. But I will tell you, bonds have done worse than the stock market the last few years. So I would say that the wiser play would have been less bonds and more stocks, but hindsight is 20/20 and the future isn't. So they've come up with these ways to charge you a fee to do really nothing for you. And that is just say, oh, here's a stock and bond fund. For example, if you're going to retire in 2050, that's 25 years from now, then right now you can have 90% stock and 10% bonds. Oh, that's great right now. Now, stock market might crash and it might take 10 years to get that back. But as you go towards your retirement date, it's going to gradually get down to a 50 stock, 50 bonds. Honestly, 50% in the stock market, if you can't afford to lose 50%, and by the way, 50% in the bond market, which could also go down 10 or 20% in a couple of years, that doesn't sound risk off to me. It doesn't even sound wise to me. That if you have your entire 401k and all your retirement money in a 50-50 stock and bond portfolio, you're still 100% at risk. You're not 50% at risk, you're 100% at risk. Now, you're not going to lose 100% of your money, but the bond market could go down 10 or 20 in a couple of years. We just saw it happen. the stock market go down 50% in a year or two. We saw that happen twice in the last couple of decades. We saw it go down 20% a couple of times. Just earlier this year, it went down 20%. 2018, it went down 25%. There was about a 30% correction, even 40 on some indexes in 2022. And they kind of kicked the money printing into gear and kind of saved that from going down 50% like the prior crashes. But again, money printing did what? It just created more inflation, created interest rates to have to go up, and created more damage to the bond market. So did it really help us? No, it just made the stock market not correct to a relatively reasonable, sane level to buy stocks. We could have kept the bond market probably intact if we'd have just let the market do what the market should do, and that is follow the market. Basically, base it on what people are willing to buy and trade a stock for rather than what the government pumps into the market so people can overpay for stocks. Again, just a lot of weird things that happen. But target date funds, I think, are a waste of time. I think if there's some that claim to be managed, like they'll put a manager on there. And so maybe that's where the new managers that they hire from financial schools, from Wharton or Harvard Business School, they say, oh, you want to be a fund manager? Well, here, try out on a target date fund, play around with these, just keep it 50-50 and see how it does. I don't think any of them that I've seen are managed by any manager that has a great resume. Yeah, I haven't looked at all of them, but that's my impression, is they're kind of like just out there kind of auto funds. I don't like it. You can do a lot better picking your own stocks, taking money off the table and putting them into principal protected accounts as you near retirement. You can do better without bonds when the bond market looks like it's going to be going down for a few years, like we knew a few years ago it was going to be. We haven't been in bonds. The only thing we've been in bonds has been short-term bonds. We're starting to get back into bonds now because interest rates are starting to drop, right? Powell's committed to drop interest rates over the next year or so. And we've kind of seen that. We've kind of started down that track now. Is it going to continue as interest rates go down, as those short-term interest rates go down? And if the Fed continues to buy bonds by driving the price of bonds up, driving the interest rates down, we might see lower mortgage rates, but we might see higher house prices because inflation usually happens when you drop interest rates. The other thing when you drop interest rates is it creates a fear that we really are in recessionary times. And sometimes that causes a market sell-off. So do you really just want to be in a static buy and hold 50-50 or 90-10 stock bond portfolio and not do anything about it until 2050, 25 years from now and hope it worked out? Maybe history says it would work out over a 25-year period, but I'll bet it would work out better if during times when you had a high probability that you'd make money on bonds, you were actually more skewed towards bonds right now. For example, I'd rather you be in 50% bonds going forward and 50% stocks, so your risk after this huge market run up is lowered. And now that bonds are priced high and we're lowering interest rates, bond prices will likely go up. So let's do what's likely to happen, not just some static, we don't care what the market's doing, we're just going to have you in this mix no matter what. There's no brains behind it, no planning behind it, no management behind it. There's nothing. And you're paying a fee for that. It drives me crazy that there would be such a thing, but there are, and that's the way it goes. So yeah, we don't like them. We do active management. We actually look at the market, look at the situation you're in, and make those adjustments accordingly based on the times of the day, not the times of 25 years from now.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about target date funds, and as you said, in your opinion, they are a waste of time. Our telephone number, 520-780-9059. You can call that number if you'd like to talk to Jeff about target date funds or pretty much anything that applies to your retirement, 520-780-9059. Jeff, interest rates have most recently dropped. Fed Chair Powell did his job finally. Where do you see interest rates going here towards the end of the year? Do you see another rate cut? And I know you don't have a crystal ball, but if you can prognosticate, what do we see for the beginning of 2026?
Yeah, in an earlier segment, I was talking about that. What I see is a choppy market going forward. I think a lot of pressure, downward pressure on the market, just because throwing in the towel on interest rates, holding them high to try to curb inflation. Basically, we gave up on the inflation fight, right? That's really what he's saying is like, okay, Trump's been hammering me. He's getting mad at me because I haven't really been doing a good job, but we'll do what he says now. And we're just going to lower interest rates because it'll stimulate the economy. Well, it might help businesses borrow money at a slightly lower rate. It'll help banks' Fed funds rate, overnight rate go down. If they do, in fact, buy bonds back, which is pumping money into the economy, that will affect the long-term interest rate. But, the lowering of interest rates only affects the overnight, the short-term interest rate. All it affects is your money market accounts and maybe what you can get off of CDs or interest at a bank. It doesn't affect mortgage rates and all those other things. You have to buy and sell bonds to affect the long-term interest rates in that nature. Now, unfortunately, China and all kinds of other countries have been buying our debt. Other central banks, not American, own a lot, like trillions of dollars of the American bonds. And if they want to counter our efforts to drop interest rates by buying bonds and putting money into the economy, You know what they can do? They can just sell all their bonds. China could sell trillions of dollars worth of bonds, drive the market down, drive our interest rates up, and basically give us the finger and put it right in our face. So there's not a clear way out going forward, but I do believe that this first interest rate basically is showing that we're throwing in the towel on inflation. Inflation is going to probably rear its ugly head again. And it also shows that the only reason they would do that if the economy's not as good as what they say it is on the news. It's not as good as they say it is. The economic indicators are still going worse. We've got great things ahead from the standpoint of Trump giving incentives for companies to bring their manufacturing back and tariffs and all that other stuff that's raising money for us. But those things aren't done in an instant. There's going to be likely a recession because that's what always happens. As soon as the rate cuts come, recession follows, market sell-offs follow. Things get crazy. People get worried and scared. Then they think the sky is falling. And then all of a sudden, the market gets back to a reasonable place. Companies who are building plants and manufacturing over here start finishing that up. They're offering new jobs. The economy gets better. And hopefully it'll happen before the next election. Otherwise, they'll blame Trump for starting the recession that we may still be in. Sometimes recessions take more than a few months to get out of. They take years sometimes. It wasn't just an immediate thing after the 2008 bubble with the banking crisis. Shoot, houses were still being foreclosed on in 2010 and 12, even though the stock market started going up in 2009. I think people felt we were still in a recessionary period for a few years after that. So we'll typically see the recession start before the market starts going down, and the market will start going up before the recession really ends. And that's just how the market cycles have worked in the past. So I do see future rate cuts due to trying to fight recessionary factors coming forward. Yeah, we've been kicking the recessionary can down the road for about 2 years now. It's been due. Industry says it's due. It comes when it wants to. It doesn't come when I say it will, or when the Fed says it will, or when the president says it will. It'll come when it wants to. And there's some things they can do to kind of kick that can down the road and push it off. And they've done everything they can. But eventually that bubble is going to pop, and it's just that can kicker is just going to run out of gas. You know, it just can't be kicked down the road forever. I don't think. Some people think it can go overvalued and stay overvalued forever. People have thought that in the past, and it didn't. We'll see if this cycle's different, but so far all the cycles have been mirrors of the past cycles, and I think we'll eventually get there with this one as well. So again, yeah, future rate cuts still ahead. We might actually admit that we're in kind of a recession, maybe even a steep recession, depending on how big the market sell-off happens. But I think there will be a market sell-off where we'll reprice the market. They won't let us say crash or correction anymore in the market. They say, well, stock prices will reprice to the downside. And they're saying these stupid buzzwords to make it sound like it's not as big of an event as it is. The fact is, prices typically do return to equilibrium, and they'll probably get there. I don't know when, but we have to be prepared for it. Let's take advantage of the market while it's good, take advantage of strength when it's there, but let's not be stupid and write it down if it starts falling apart either. So that's why a good advisor who pays attention to that stuff is probably a wise idea to align yourself with, whether it's us or somebody else. You know, we pay attention to that kind of thing. I think we do a good job with that. You know, our first rule of thumb is don't lose money you can't afford to lose. And we have a lot of people that have millions of dollars that I think they could probably afford to lose some that don't want to lose some. Well, great. We can be safe. We don't have to play this roller coaster ride game with the market. If you're a little more aggressive, then be more aggressive if you want to be. But again, understand the risks. Don't take them lightly, and invest wisely.
You're listening to Jeff Ogun of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the market, the economy on today's radio program. Once again, I want to remind you, if you would like to have a consultation with Jeff, just a casual conversation about your journey towards confident retirement, we're offering it no cost, no obligation, entirely complimentary. 520-780-9059 is the number to call to get yours. You can make that call right now. 520-780-9059. You can also find out more about us online at primrad.com. Jeff, out of time for this week. Thanks so much for your time, but most importantly, as always, I want to thank our fine listeners for joining us here in the greater Tucson area. So for Jeff Ogun, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.